Welcome to the KNAV State of M&A debate that tracks the winds of change impacting mergers and acquisitions in India. We are now in 2017, a year which is seeing the emergence of a new environment. So what type of changes in M&A activity do we expect to see in the near to medium term? Will the quantum of inbound investments in 2017 provide the acid test for the real impact of Prime Minister Modi's ongoing campaign at a global platform where the thrust has been on Make in India? To discuss and debate on these, I am delighted to welcome a distinguished panel. Gentlemen, welcome to the KNAV State of M&A debate. Let me first turn to you, Vaibhav. KNAV has done an assessment of the general outlook of various respondents in India. Could you tell us a little about this study? And could you also throw some light in terms of some trends that may have emerged, particularly in the context of valuations and also the industries where we expect to see M&A activity in 2017?
Sometime earlier this year, we felt the need of a nationwide review, a survey of what is happening to India Incorporated. In that context, it was important that with 2016 fading into 2017 and the recent drives of the government, the increased M&A activity, the increased FDI, the increase in transparency, we thought it's important to reach out to all stakeholders. Therefore, we conducted a survey. We reached out to almost 3,000 respondents, and there was one real nerve that came out of the respondents, and that is India is there, we have arrived, and there's tremendous optimism. When we analyzing the trends, it was very interesting to find that manufacturing was also right up there. It started with technology being number one, manufacturing number two, life sciences, healthcare number three, media, entertainment, followed by energy. Now, one may think that why manufacturing? But clearly, the organizations which we surveyed and the response that we got, they clearly found merit in acquiring businesses with manufacturing assets outside. And that, I think, has got a lot to reflect with the current valuations. You're getting some amazing assets at amazing valuations. It's a question of identifying them, doing the right diligence, and then carrying on that diligence into a fruitful acquisition. So I would surmise by saying that valuation trends are looking positive, although one cannot generalize valuations, but typically you're getting good deals today. It's a question of having the right mirror and identifying the right asset.
Positive it is, Jatin. The Max Group has recently announced a mega merger with HDFC. And from what I understand, once all the formalities of the merger are completed, you will probably have one of the largest insurance companies ever in the country. Could you tell us as to what this will do in terms of setting the trend for the insurance sector?
Sure, Manish. I think this will be very positive for the insurance industry. Ever since we have announced the transaction, our trading multiple has expanded to about 4 times embedded value. We saw another life insurer doing its IPO, which was at almost 40% premium to the valuation at which they had already done a private placement. There was a recently announced transaction by another life insurer wherein they could also do it at a far premium multiple in the market. So we really set the trend for expansion and valuation for the life insurance players. And they are sort of trading at far superior valuations which they were prior to the merger. So I think we clearly see that encouraging a lot of other players to sort of pursue consolidation. A lot of these smaller players who've not been able to really make their mark, who've not been able to perform as well as some of the larger players have been, are clearly available for consolidation. In fact, the combination which this merger creates is so powerful that we could really, we'll have the capacity in terms of the solvency surplus as well as the profitability to be able to consolidate multiple other players within our fold itself. So we could be a driver of consolidation possibly every second year if this merger was to go through, because there's significant value which this merger brings to the platform.
A trendsetter that is. CM Sharma, having a high liquidity is an important factor when pursuing acquisitions. In the KNAV M&A expectation survey, about 30% of the respondents stated that they would use cash from their internal sources to fund the transaction. There are, of course, various other ways in which transactions can be funded. You've got equity swap, you've got management buyouts, and a whole lot of other avenues. In your view, why is it that there's only 30% that is currently looking internally to fund their transactions, and what sort of trends do you see emerging in terms of the other options going forward?
Funding most likely depends upon the your cost of capital, and there are various ways you can fund the acquisitions. Traditionally, it used to be kind of 100% equity, then the term loan, term debt came, and then it's a mix of term debt and the equity. And recently, what trend I started seeing, and particularly which I have very strong, I've used innovatively in the past to fund our acquisitions, is kind of the LBO is kind of very kind of attractive tool, which helps to do lots of MBO. You talked about management buyouts, and that's how the management buyout. The management does not have the equity, right? And they have limited amount of money, and sometimes they get the private equity investor to back them. But largely, it is driven out of the kind of LBO where they can lever the balance sheet of the target company itself. And because what happens, the cost of fund when you fund through the debt is much cheaper than the cost of fund when you fund through the equity. And equity inherently, like is very, very high cost, and the debt is kind of since there is a security available to secure that the financing, it's quite attractive. And that's what I have seen in the past, and personally I have used those acquisitions which I have handled in the past, largely LBO kind of structure where we borrow the money in the target company itself, and that helped us and create huge value for the shareholders, because then you need little amount of equity, and largely money is coming from the banks, and there are enough lenders out there, whether it's kind of series like term loan A, term loan B, there are mezzanine debt, there are various structures available, and these were the structure which was not traditionally we have seen 10-15 years back, but now this is we see quite often. And we feel, I think, because of all these plenty of innovative structure and the new options available, the M&A has become very, very easier now, and it is very, I can say it has become the affordable also. So that's where I see the trend, more like kind of judicious mix of debt and equity. And in the debt also, you can it's up to you how you can lever it, whether target, holdco debt, and there are several ways you can handle these transactions.
Clearly, that's experience shining through all those options. Pratap, on that note, let me come to you. From the activities that we've seen in 2016 till now, and going with the mood of approximately 83% of the respondents of the KNAV survey, there appears to be a relatively large appetite for smaller ticket transactions, i.e. transactions that are up to $10 million. My question to you is, what has led to this situation? And do you see this trend continue into 2017?
Manish, if you actually look at it in the past 2 years, there have been some big ticket deals because of which the ticket size on an average was working out higher. And probably we did not see many of those happening in 2016. So you would find that the average deal size is smaller in 2016. So strictly speaking, one would like to understand whether corporates are willing to take that extra bit of risk for doing a big ticket deal using cash on the balance sheet. That is the issue. So I see from a risk perspective that the sweet spot is somewhere between 10 to 12 million, even going forward. But having said that, I also feel there are opportunities coming up in 2017 which are on the big size as well. For instance, I can imagine there can be a business plan re-engineering that can happen in the organized retail, especially because there have been developments in the last 1 month or so which can realign organized retail in especially tier 2 and tier 3 cities. Similarly, there is a strategic play possible in the e-com sector. There is consolidation play possible in the financial services sector. My co-panelists have already indicated about the insurance potential. Well, you have life sciences pharma already happening in the outbound space. European valuations are pretty attractive at this stage. So I do feel there is scope for big ticket deals, but I would still reckon that the sweet spot going forward will be in the 10-12 million range.
Thank you, Pratap. And Vinod, on that note, let me ask you about the intricacies of M&A. We've seen that M&A is notoriously a very difficult undertaking. A high percentage of M&A transactions clearly fail to realize their goals, their growth targets, and anticipated rates of return. In your view, what are some of the challenges that you encounter when you are pursuing M&A transactions, specifically at the stages of targeting, and what are the key risks that you generally combat in concluding your M&A transactions?
As you have said, 2017 will be an exciting year for M&A, and I also think that with all the geopolitical movements that have happened across the world, Europe, in the United States, I think there'll also probably be a lot more aggression on the part of Indian companies that may probably looking outward. Having said that, I think some of the key issues and some of the key risks which I have sort of felt and I've sort of seen in my career in some of the transactions that I've pursued are there out there, and some of these are also risks which are fairly obvious. One of them is the post-deal integration. A lot of M&A activity and a lot of the M&A deals have actually failed to realize the true value, primarily because integration hasn't been done well enough, and because integration has essentially failed. Another key risk which I have personally as well seen has been the fact that due diligence has shown up a lot of surprises that both the buyer and the seller were not necessarily prepared for, in which case the deal transaction and the deal value had to change, and in some situations that has actually jeopardized the entire deal, in which case it actually impacts the companies, and it impacts customers, it impacts financial situations. You actually see attrition going up and increasing within some of these companies as well. So those are some of the key risks. There is also risk with regard to reputation when some of these transactions don't necessarily go through. You also have risks with regard to regulatory and protectionism that sometimes comes up, especially when mega mergers happen. You also now have fairly a significant amount of risk with regard to key assets, primarily in IP, as well as key personnel who sort of move out when transactions happen. And in a lot of situations, when you're factoring in valuations of the companies, you're actually factoring in key resources, which includes your IP and your people. And in some situations, you actually are not going to be able to actually sort of retain them. The other big risk is the fact that a lot of companies don't necessarily plan well for this and don't necessarily have enough communication. In one situation there's too much communication, or in some situations there's not enough communication, and in those situations the deal necessarily doesn't really go ahead or doesn't necessarily provide the kind of synergies and be able to sort of realize the value from the proposed merger.
Thank you, Vinod. On the other side of risks are opportunities. Stay with us. We'll be right back on the other side of the break. Before we went on the break, we spoke about intricacies of some M&A transactions and risks. Jatin, the Max Group has been very active in almost all types of M&As, particularly over the last couple of years. Could you share with us some of the areas that you particularly tend to focus on to bring about success, to unlock the true value for the stakeholder?
Sure. So I think the biggest focus area for us really is the value creation for all stakeholders. Purely through mergers and acquisitions, divestments, and joint ventures, etc., which we did over the last 2.5 years, we've actually grown the shareholder wealth by about 4 times.
That's amazing.
Yeah. So the stock has moved up almost 4 times over the last 2.5 years. Now that we've been able to do because of bunch of things. So first we did a demerger through which we brought structural clarity for investors. We gave investors a pure play access to the life insurance business through a listed company called Max Financial Services. We gave them access to the healthcare businesses, portfolio of healthcare businesses, through Max India. And we gave them access to another entrepreneurial venture of the Max Group, which is where Max started in 2000, in the realms of Make in India, Digital India, Skilled India, Startup India, etc., through Max Ventures. So we've done fair bit of restructure to bring that focus and clarity. Now, having done that, we created platform for the next level of growth. For the healthcare business, we rejigged out both our joint ventures because our healthcare businesses are currently in the nascent stage, very sharp growth, etc. So we needed capital to grow those businesses. So to grow those businesses, we raised capital by rejigging our joint ventures to equal partnerships, approximately equal partnerships. Now that capital could pave the way for two seminal acquisitions which we did, which really has put Max Healthcare in a different orbit. It's the fastest growing corporate healthcare chain in the country today, but also it's well positioned for the next level of growth. I mean, for example, our Saket expansion, once it's fully built out, will be about 2,000 beds. It will be largest hospital in Asia. So it's being positioned like that. So we've created enough growth opportunities for Max Healthcare as well as capital for Max Bupa to take it to break even and sort of grow as the entire industry is growing and outpace that growth. And last but not the least, the new sort of baby, which is Max Ventures, we've embarked upon multiple businesses in the space which I spoke about. So we're starting a real estate business. We are starting education business, setting up some schools around. Even real estate is across North India. So this will also be education will also be focused to start with in North India. And we also want to incubate some startup investments through our initiative called Max Investments, and then our packaging film business. Because of Make in India, we are again growing and making a leapfrog. So those are some of the things we've done over the past few years.
Well, moving from one success case study to several, if I may, CM Sharma, you've helped a large Indian group extend its market coverage from just being India-centric to include several countries across the globe in terms of mergers and acquisitions to, I would say, to achieve a true global organization status. What are some of the typical challenges that you faced in closing your M&A transactions?
Sure. As I stated, I'm very fortunate to have led the more than 15 acquisitions in the past and expanded the business from one India-centric to 13 countries, from maybe 6 people to 55,000 people, and so that's kind of, and from almost nowhere to everywhere, I normally say to the people. And each and every challenges whenever we went to the different countries to expand our footprint, it's a different challenges we have faced. And somewhere, like at the time of deal negotiation, as my co-panelist has just said that diligence phase, sometimes you really get lots of surprises, which nobody is prepared, neither the buyer or not the sellers. Then how to deal with those situations? Sometimes that led to, in one deal, a deal fell through, it did not go through, and because it was really big surprise. But most of the deal what we close, sometimes you adjust the value to just take care of the cost. It's difficult for both for the seller because they were not prepared. For the buyer also, look, this is how they adjust. Like for buyer also, it is not they don't expect kind of unexpected, because that's